Hello and welcome to our Q2 2019 market commentary. I'm Darrell, Head of Investments here at Valley National Financial Advisors. Both equities and bonds have gotten off to a very strong start in the first half of 2019, but those rallies have been pushed forward by very different factors. We'll get into how we can reconcile some of those differences in just a moment, but to start off, equity markets in the second quarter were choppy, with performance across individual companies and sectors looking very different. A lot of that choppiness has to do with the shroud of uncertainty that continues to overhang markets with respect to the United States-China trade relationships. But even so, despite all of the concerns regarding the slowdown in global trade, equity markets pushed forward in June and briefly touched all-time highs. The optimism that came about in June was primarily a result of the Federal Reserve and the expectation that the Federal Reserve will begin cutting interest rates later this year. At present, equity investors seem to be painting a very rosy picture of the future, and that has helped to propel markets to double-digit returns in 2019. But the bond market rally has been powered by a much more sobering outlook, one of lower inflation and a lack of economic growth. With that as a backdrop, Treasury rates have continued their precipitous decline throughout the year, and now sit at their lowest level since 2017. In fact, the futures market now predicts over 100 basis points of interest rate cuts before the end of 2020, which would essentially mean a complete reversal of 4 previous interest rate hikes. So with equities and bonds seemingly at odds with each other, there are some interesting implications for portfolio construction. In our view, the only way that both the stock and bond market can be proven right is if the bond market is correctly predicting that the Federal Reserve will take a look at global growth and feel the need to enter into a much more aggressive mode of monetary easing. And in that situation, that monetary easing would likely lead to further gains in the stock market. There is little in recent history to suggest that this scenario isn't plausible, but we do need to acknowledge that there are a number of other possibilities on the horizon. And the next few months will go a long way in helping to inform us of how resilient the current bull market really is. At this point in time, we are cautiously optimistic and continue to recommend a neutral and balanced approach to portfolio construction. As always, we'll continue to monitor things throughout the third quarter, and we'll be back at the end of September with another update. Thanks for watching.